Options and derivatives. Recent decades have seen an increase in the complexity of investing due to the development of several derivative products that provide novel approaches to managing finances. Derivatives have long been used to reduce risk or increase rewards, particularly in the farming sector. In such a situation, one party to a contract consents to sell commodities or animals to a counterparty who consents to purchase those goods or livestock at a particular price on a particular date. When it was initially adopted, this contractual approach, which replaced the straightforward handshake, was innovative. The most straightforward derivative investment is an option contract. Their value is based on the value of the underlying security of the contract. The possibility to buy or sell the underlying security is provided via options. The investor places a wager on the asset's price direction without actually owning the underlying asset. Derivative products come in a variety of forms, such as options, swaps, futures, and forward contracts. Although derivatives offer a wide range of applications and hazards, they are generally regarded as a safe way to engage in the financial markets. A derivative security is one whose pricing, risk, and fundamental term structure are determined by the underlying asset. Derivatives are used by investors to cover a position, raise leverage, or make predictions about the direction of an asset. Derivatives can be purchased or traded on an exchange or over the counter. Options, swaps, and futures or forward contracts are only a few examples of derivative contracts. Market risk, liquidity risk, and leverage risk are some concerns related to derivatives. Term review in brief. Because they entail unfamiliar concepts, derivatives can be challenging for the general public to comprehend. For instance, counterparties who take the other side of the trade exist for numerous instruments. The underlying asset of every derivative determines its pricing, risk, and fundamental term structure. The perceived risk of the underlying asset affects how risky the derivative is thought to be. A strike price could be included in the derivative's construction. The cost at which it may be exercised is as stated. A call price, which denotes the price at which an issuer can convert a security, may be present in fixed income derivatives. Numerous derivatives compel the investor to adopt one of three stances: bullish with a long position, bearish with a short position, or neutral with a hedge position that can have both long and short elements. What role derivatives can play in your portfolio? Leverage to preserve value. Derivatives are frequently used by investors to hedge positions, boost leverage, or make speculations about the direction of an asset. Hedging a position is typically done to safeguard or provide insurance against the risk of an asset's undesirable price movement. For instance, a stock owner might purchase a put option on their shares in order to safeguard their investment portfolio from a drop in the stock's price. They so adopt opposing stances about the same security. According to the plan, if stock prices fall and they lose money, they will win money on the put option at the same time, since the put should gain in value. The increase can cancel out the loss in stock value. The shareholder gains money from the increase in value of the stock in their portfolio, however, if the stock price rises as anticipated. But they also lose money on the put option price they paid. A shareholder who hedges knows that if prices rise, they may be able to profit more without having to pay for the insurance provided by a derivative. The hedge, however, is set up to lessen their loss if prices go against them. Leverage. The power of it. Leverage can be significantly raised using derivatives. Leverage in the context of derivatives refers to the possibility of influencing a significant contract value with a relatively small sum of money. Options-based leveraging performs particularly effectively under erratic market conditions. Options magnify price movements that are big and in a positive direction for the underlying asset. Since the CBOE Volatility Index (VIX) also forecasts the volatility of S&P 500 index options, many investors use it to assess possible leverage. Both the value and cost of puts and calls can rise during periods of high volatility. Speculation. Derivatives are also used by investors to speculate on the asset's future price. Due to the fact that options allow investors to leverage their positions at a fraction of the cost of an identical quantity of underlying asset, large speculative plays can be conducted on the cheap. Leverage can be significantly raised using derivatives. Options magnify price movements that are big and in a positive direction for the underlying asset. Derivatives trading. Both over-the-counter (OTC) and exchange-traded derivatives can be purchased or sold. OTC derivatives are contracts that are formed informally, such as swap agreements, between parties. On the other hand, exchange-traded derivatives are standardized contracts. Trading over-the-counter entails counterparty risk due to the lack of regulation around contracts, whereas exchange derivatives are not, since clearing houses serve as middlemen in these transactions. Derivatives-related risks can take many different shapes. One is market risk. Another is the risk of liquidity. The leverage risk of unfavorable market movements when high margin amounts may be required is also present. Trading on unregulated markets carries risk. There is also a danger that a proper value cannot be established for complicated derivatives formed from many assets. Derivatives by types. Contracts can be of three different types. Options, swaps, and forward futures contracts are a few of them. There are numerous versions for each of the three. Investors who enter into options contracts have the option to buy or sell an asset, but they are not required to do so. In order to gain exposure in the event of significant price fluctuations without taking a position in the underlying asset, investors frequently employ option contracts. There are other choices techniques, but the following are the most popular ones. Long call. You predict that the price of a security will rise. The right to own, call, the security is purchased, go long. If the market price of the security is higher than the exercise price by an amount more than the premium paid for the call, the long call holder will profit. Long put. You anticipate a decline in a security's price. You purchase the option to sell, go long, the securities. If the market price of the security is lower than the exercise price by a sum greater than the premium paid for the put, the long put holder will profit. Short call. You predict that the price of a securities will fall. You write, sell, a call. The holder of the call, who is the counterparty when you sell a call, decides whether or not the option will be exercised. Your payment as the call's writer is the same as the premium the call's buyer gave you. If the market price of the security increases above the exercise price, you could lose money. This loss would be largely offset by the premium you got. Short put. You anticipate the price of the security rising. An option is sold, written. Your reward as the put's author is the premium that the put's purchaser paid you. The market price of the asset must not drop below the exercise price, otherwise you will lose money. You would partly make up for this loss with the premium you earned. Swaps are derivatives in which opposing parties trade cash flows or other elements linked to various investments. A swap happens when one party has a comparative advantage over the other, for as when one borrows money at variable interest rates, while the other may borrow more easily at fixed rates. Plain vanilla is the name of the most basic swap variety, but there are many others, such as interest rate swaps. Parties trade one loan with a fixed rate for another with a floating rate. One party may agree to a swap with another party to swap its fixed rate for a floating rate in order to match liabilities if it has a fixed rate loan, but other obligations with variable rates. Option methods can be used to engage interest rate swaps as well. The owner is given the option to engage in the swap but is not obligated to do so. Currency swaps. In this arrangement, one party trades loan payments and maybe principal in one currency for payments and possibly principal in another. Commodity swaps. A legal arrangement in which the parties and the counterparty exchange cash flows that are based on the value of an underlying commodity. Forward and future contracts include parties agreeing to buy or sell an item at a specific price in the future. The spot price or the most recent price is typically used to draft these contracts. The difference between the spot price at the time of delivery and the forward or future price is used to determine the purchaser's profit or loss. These contracts are often used to speculate or hedge against risk. While forwards are non-standard and traded over the counter, futures are standardized contracts that trade on exchanges. Are equity options considered derivative investments? Yes. Investments that are produced from or created from an underlying asset are known as derivative investments. A stock option is a contract that grants the buyer or seller of the underlying shares the ability to do so. The option trades independently, and the price of the underlying stock determines how much it is worth. Does leverage affect derivatives positively or negatively? It is both possible. The benefit of a derivatives leverage is that investors can purchase a significant portion of the value of the underlying securities for a relatively small initial investment. For illustration, a $100,000 Treasury bond futures contract has a face value. The initial margin needed to buy the contract is a small portion of that sum, often between 3% and 12%. The drawback of leverage is that if the market price of the contract sufficiently declines, an investor will need to either put up additional funds or close their position. Some people might not be able to handle this quantity. Where can I buy derivatives? Depending on the derivative, it is typically bought and sold either through the over-the-counter market, OTC, or on a centralized exchange. There are unregulated exchanges where some derivatives are exchanged. The conclusion: long, short, or neutral derivative strategies are available to investors wishing to hedging, speculate, or increase leverage in a portfolio. Only if the investor is fully aware of the risks and comprehends the impact of the investment within a larger portfolio strategy does the usage of a derivative make sense. Thank you for watching this video. In the next video, we will discuss more on financial topics. Don't forget to subscribe and hit the like button and leave a comment.